Welcome to the Opening Bell Report.
Welcome in. It's really great to have you here with us today.
Yeah, glad to be here.
Whether you're prepping for a big meeting, tracking movements in the healthcare sector, or, you're simply one of those curious people who loves deconstructing a massive corporate comeback, we have something specifically tailored for you today. Our mission for this deep dive is to dissect an analysis report covering one of the most remarkable fundamental turnarounds currently playing out on Wall Street.
It really is.
We are diving deep into Talkspace, trading under the ticker symbol TAW, ATCO, and we're looking at the mechanics behind their staggering 579% profit surge.
Right, and it's a phenomenal case study in corporate agility. If you look at the digital health sector over the last 2 years, you were essentially looking at a graveyard of pandemic-era darlings.
Oh, absolutely.
We saw a wave of companies that were suddenly thrust into the spotlight in 2020, only to spend the next few years just bleeding cash.
Yeah, watching their customer acquisition costs completely detach from reality.
Exactly, and eventually seeing their stock prices just crater.
And Talkspace was right there in the trenches with them. Just to set the stakes for you, we are talking about a company that was, not too long ago, trading below $1. They were facing the very real, very imminent threat of being delisted from the exchange entirely.
Yeah, things looked incredibly bleak.
Fast forward to the present, and the source data we're looking at outlines a highly calculated survival strategy.
Okay, let's unpack this, because going from the brink of delisting to a 579% year-over-year surge in net income does not just happen by accident.
No, it doesn't.
And it certainly doesn't happen without leaving a blueprint.
That is the crucial framing to keep in mind as we analyze these numbers. This isn't some meme stock rally driven by retail traders on a message board.
Right.
What we're looking at is a masterclass in corporate restructuring. It proves exactly how powerful a ruthless, calculated shift in business strategy can be when the execution is flawless. To really appreciate the mechanics of that comeback, though, we have to establish what went wrong in the first place.
The direct-to-consumer trap.
Exactly. The core problem was their heavy reliance on that DTC model. During the pandemic boom, Talkspace, like almost everyone else in the telehealth sector, leaned heavily into direct-to-consumer marketing.
Yeah, they spent tens of millions on celebrity endorsements.
Hyper-aggressive ad campaigns, all to acquire everyday individual patients.
And, the DTC model made perfect sense at the peak of the lockdowns.
When consumer discretionary income was high.
Right, and therapy was suddenly entirely virtual. But the economics of that trap are what ultimately caused the crash across the entire sector.
Because when the pandemic boom faded, the macroeconomic environment shifted violently.
Exactly. Inflation hit. And when inflation hits, everyday consumers audit their spending.
Groceries cost more, housing costs more. So paying out of pocket for a recurring therapy subscription is, well, it's one of the first things to get paused.
Precisely. And in a high inflation environment, the unit economics of a DPC telehealth business just fundamentally break down.
The copy?
Right, the customer acquisition cost.
Yeah.
The cost to acquire a single patient started to drastically outpace the actual lifetime value that patient was bringing into the company. If you're spending $500 in performance marketing to acquire a user, but they churn after spending only $200 because their own budget is tight.
The business model essentially becomes a machine that destroys capital.
You're literally paying for the privilege of losing money.
Wow. And prior to this turnaround, our analysis report shows Talkspace was aggressively burning through their cash reserves.
Yeah, generating deeply negative profit margins.
That's looking down the barrel of a reality where the runway just simply ended. The cash was going to run out.
Which forces a management team to make a binary choice. You either stubbornly cling to the consumer model that brought you your initial fame and inevitably file for bankruptcy.
Or you completely reinvent your foundational revenue mechanics.
And they chose reinvention.
That brings us to the catalyst in late 2022, when the board appointed a new CEO, Dr. John Cohen. Here's where it gets really interesting, because the new management team didn't just tweak the ad spend or try to optimize their conversion funnels. They executed a complete strategic pivot away from that DTC cash burn model. They looked at the landscape, realized the consumer was tapped out, and shifted entirely toward deep-pocketed institutions.
It was a highly effective two-pronged strategy. They transitioned to a B2B and payer-backed model.
Break that down for us.
So the first major prong of this was integrating into insurance networks. Instead of trying to convince the individual to pay out of pocket, Talkspace embedded its platform directly into major health insurance routing.
Okay.
The data in the report shows that today, a massive 75% of Talkspace's total revenue comes directly from payers.
Meaning it's covered by the patient's insurance.
Exactly.
Which removes the financial friction for the user entirely. But wait, shifting from a nimble tech startup running Facebook ads to dealing with massive, slow-moving insurance bureaucracies. Oh, it sounds like a massive logistical nightmare.
Right. The sales cycles alone in the healthcare industry can take 12 to 18 months. How did they bridge that gap without bleeding out the rest of their cash?
They did it by ruthlessly cutting their DTC marketing spend to extend their runway while the institutional contracts materialized.
Wow.
And that leads to the second prong of the pivot enterprise contracts. They went directly to large employers and integrated Talkspace into corporate benefits packages.
So they bypassed the consumer marketing bloodbath entirely.
Exactly. And started selling bulk access to Fortune 500 HR departments.
Which perfectly addresses the core vulnerability of the therapy business model, the churn rate.
Yes.
Because therapy is hard work, and when you layer financial stress on top of it, the churn rate skyrockets. But when you look at the psychology and the unit economics of this B2B model, it completely flips the script.
What's fascinating here is exactly how this pivot fundamentally altered their LTV to CAC ratio.
The lifetime value versus customer acquisition cost. Right. Patients naturally stay in therapy significantly longer when their employer or their insurance provider is footing the bill. The financial friction is gone.
So the lifetime value of that patient goes through the roof because they stay for a year instead of 3 weeks.
Exactly. And simultaneously because the corporate partner is driving thousands of employees to the platform in bulk.
The customer acquisition cost drops to practically zero.
Spot on. High LTV, negligible CAC. That is the exact mathematical formula you need to build a sustainable, highly profitable subscription enterprise.
It's the holy grail for digital health. And we see the validation of that formula when we transition into the financial results, because the Q4 2025 earnings print is the exact moment Talkspace officially crossed the threshold from a highly speculative, cash-burning app to a legitimately profitable healthcare company.
It really is.
Let's deliberately break down these numbers because they are staggering.
Let's do it.
The headline figure from the analysis report is the full-year GAAP net income, which hit $7.8 million.
Which is that 579% year-over-year surge we noted at the top.
Exactly. And it is so important to emphasize, for you listening, that we are talking about GAAP net income here.
Yeah, this isn't some heavily adjusted metric where management hides their bad decisions.
Right. This is unadjusted, generally accepted accounting principles profit.
And that bottom line profit was driven by very healthy top-line expansion too. Q4 2025 revenue reached $63 million.
Representing a 29.3% year-over-year increase.
And that strong fourth quarter pushed their full-year revenue to $228.9 million.
Up 22% from the previous year.
Incredible growth.
But top-line revenue only matters if the underlying business model allows you to retain it.
Right. Which brings us to the adjusted EBITDA.
Yes. Adjusted EBITDA came in at $15.8 million. That's a 127% increase year over year.
What we're seeing here is a textbook demonstration of operating leverage.
Explain that for us.
Sure. So Talkspace already spent the capital to build out the digital infrastructure, right? The app, the IPA compliant network.
The hard part.
Exactly. Those are fixed costs. Now that they are routing massive volumes of enterprise and insurance patients through that existing infrastructure, their expenses do not scale at the same rate as their revenue.
Because the platform is already built.
Right. So every new corporate contract they sign drops a significantly higher percentage of cash straight to the bottom line.
And the market recognized that operating leverage immediately.
Oh, instantly.
When these numbers hit the wire, the stock chart formed what technical analysts call a breakaway gap.
Yeah.
For those of you tracking the charts, a breakaway gap happens when a stock price leaps over a previous resistance level on massive volume, leaving a literal gap on the daily chart.
It's the market's way of violently signaling that a new trend has begun.
Shares surged 24% as institutional investors rapidly repriced this new reality. They realized this wasn't just a struggling telehealth app trying to survive the post-pandemic hangover.
No, it's a fundamentally different business now.
It is.
And that realization becomes even more profound when you contrast Talkspace against its direct competitors.
This is a huge point. You really cannot fully appreciate the magnitude of this comeback without looking at the companies in this sector who stubbornly refuse to change course.
Let's look at Teladoc, ticker symbol TDOC.
For years, they were the undisputed heavyweight champion of the telehealth space.
They were. But the competitive analysis paints a stark and, frankly, brutal picture of their current reality. While Talkspace is executing this massive fundamental turnaround and posting record profits.
Teladoc just posted a staggering net loss of over $200 million for 2025.
Yeah.
A $200 million loss in a single year proves that sheer scale means absolutely nothing if your underlying unit economics are broken.
Exactly. And the pain point for Teladoc is heavily concentrated in their BetterHelp division. BetterHelp remains deeply entrenched in that dying DTC model. They are still pouring capital into podcast reads and social media ads, fighting for individual consumer signups in a macroeconomic environment that just no longer supports it.
The result is that BetterHelp posted flat sales growth, specifically negative 1.5% for the full year 2025.
And their active user base is actually shrinking.
They are trapped in the exact same cycle Talkspace managed to escape.
Yep.
Which makes you wonder, why couldn't Teladoc just execute the same pivot? It seems obvious in hindsight.
It does. But shifting an enormous infrastructure built entirely around consumer performance marketing over to enterprise integration, it's like trying to turn an aircraft carrier in a canal.
That's a great analogy. Talkspace was nimble enough to do it. Teladoc is bogged down.
And Amwell, ticker AMWL, is dealing with a similar nightmare. They are struggling with negative 2.0% year-over-year growth, severe ongoing cash burn, and are currently fighting just to maintain their exchange listing requirements.
This deep contrast in operational performance really brings us to the balance sheet.
Yes, the fortress balance sheet, as the analysis report calls it.
I love that term. They achieved this massive profitability swing with zero structural debt.
Let me emphasize that. Zero structural debt.
Zero. And they are holding $92.6 million in cash.
Which isn't just a massive safety net, it's a critical measure of earnings quality.
Right.
A lot of tech and digital health companies report what they call positive operating cash flow. But when you look under the hood, it's an accounting illusion.
Achieved through heavy stock-based compensation.
Exactly.
Yeah.
They pay their engineers and executives in stock instead of cash, which dilutes the everyday shareholder and makes the cash flow statement look artificially healthy.
Talkspace isn't playing those games. That cash generation is genuine, driven by their core enterprise business model.
It gives them the actual firepower to invest in further growth, while their competitors are just trying to keep the lights on.
And Wall Street analysts have clearly taken notice of this divergence. They've been aggressively upgrading Talkspace across the board in recent weeks. So what does this all mean for you if you're tracking the sector? Is this impressive Q4 just a one-off quarter, a brief flash in the pan, or has Talkspace established a completely new baseline for growth?
All the forward indicators from the report point to this being the new baseline. Analysts have set aggressive price targets averaging around $6.50.
Compared to the $4.80 to $4.90 levels the stock had been trading at, that represents roughly 35% upside.
Yeah, but even more compelling than the analyst targets is the company's own forward guidance.
The 2026 projections are where management is really planting their flag.
Right. They're projecting 20% to 27% top-line revenue growth for 2026.
But the most critical figure is their adjusted EBITDA guidance.
Exactly. They're projecting $30 million to $35 million in adjusted EBITDA for the coming year.
Meaning they're planning to essentially double their record-breaking 2025 profitability figures.
Yeah. And if we connect this to the bigger picture, the ultimate lesson embedded in this turnaround is profoundly simple, yet totally elusive to so many companies in the digital health sector.
Which is?
Virtual mental health can be an exceptionally profitable enterprise. The consumer demand is permanently established, and the delivery technology is seamless. But the fundamental secret to making the unit economics work is that you have to get someone else to pay for it. You have to completely remove the financial friction from the end user.
Right.
By shifting the financial burden away from the stressed consumer and onto deep-pocketed institutions like insurance networks and corporate employers, Talkspace unlocked the true scalable potential of the market.
It's a complete paradigm shift in healthcare economics. They stopped asking everyday people to take on more financial stress to treat their mental stress. And instead, they tapped into the massive recurring budgets of the corporate healthcare system. It is a brilliant pivot, and it leaves us with some critical implications for the future of healthcare as a whole.
It really does.
We have thoroughly unpacked the financial mechanics of this 579% profit surge, but we always want to leave you with something deeper to consider as you go about your day. I will hand it over for our final thought.
This raises an important question for you to explore. We just established that the secret to profitable, sustainable virtual therapy is having massive institutions, your employer or your insurance network, foot the bill. But how might this fundamentally alter the future dynamic of mental health care?
That's a great point.
When your boss or a corporate insurance actuary holds the purse strings instead of you, how does that shape the actual care you receive?
Will insurance companies increasingly dictate the length and frequency of your therapy sessions?
Right. Will corporate employers gain influence over the type of care offered or raise new, complex questions about the privacy of the behavioral data being generated on these platforms?
It's the golden rule of business. Whoever has the gold makes the rules.
Exactly. As the primary payer in digital mental health shifts entirely from the individual patient to the corporation, the very nature of the patient-therapist relationship might evolve in ways we are only just beginning to comprehend.
It is a fascinating dynamic to watch unfold as this sector continues to mature. Thank you so much for joining us for this custom-tailored deep dive. We hope it provided you with a clear understanding of the mechanics behind corporate turnarounds, the brutal reality of customer acquisition costs, and the shifting financial landscape of digital health. Keep exploring these underlying mechanics, and most importantly, keep questioning the business model.
Don't forget to like, share, and subscribe for more.